Hello, and welcome to those participating in today's panel and to those listening and watching the session on financing mining projects in Africa. And thank you to GRV Global for an opportunity to chair this panel today on a very relevant topic. I'd be nice to just say a word on Rothschild and Co. In my role as senior advisor to the Rothschild and Co mining team, it's been over 16 years now. I'm privileged to work with a bank that has been partnering with mining entrepreneurs as far back as the early gold and diamond discoveries in Southern Africa. So when we say we have long client relationships, we mean it. And copper in Spain, the original Rio Tinto mine. They've advised on the project finance of every major copper development since the boom in discoveries in Chile in the late 1970s. And I've also often worked on behalf of governments in other mining transactions, such as the Zambian privatization. I've just noticed they do not dip in and out of the sector as the commodity cycles ebb and flow, but they stick with clients over time. Their particular financing advice may change with the cycles, i.e. M&A and equity raisings at the top and debt restructuring at the bottom, but they hang in there all through the cycle. And as we all know, mining is a global industry, and the Rothschild and Co team treated as such, trying to avoid geographic silos in their client coverage. And the global mining team comprises around 40 bankers, covering the Americas, Europe, Russia, Asia Pacific, Australia, and last but not least, the vast continent of Africa. So that leads us on to the topic of today's panel, financing mining projects in Africa. We have a really impressive breadth and depth of experience in this field on the panel today. So I'd like to ask each of you to introduce yourselves and your experience relevant to today's topic. Impossible to rank you in order of importance, so I'm going to ask you to speak in alphabetical order, starting with Stefan, followed by Michael, and then Remy. So please go ahead, Stefan.
Yeah, thanks Fiona, and hello to everybody. My name is Stefan Eitel. I'm the head of the metals and mining team at KfW IPEX-Bank in Frankfurt, Germany, and on that job for 12 years now. KfW IPEX is a bit of a special animal in the banking world. First of all, the KfW Group is a state-owned bank owned by the German government. It's a promotional, non-commercial bank to foster small and medium-sized enterprises in Germany and in Europe, and also doing the development aid on behalf of the German government. We as KfW IPEX, we are a daughter company, an affiliate of KfW. We are in fact a commercial bank in a non-commercial banking group. Our mandate, so yeah, we are commercial, we are in competition with other banks, and our mandate is to promote German and European interests in projects worldwide, which in particular means in mining that we are financing projects where there is any German or European interest, which can be either by procurement, equipment from out of Europe going into projects, or in particular on mining on raw material flows out of projects back into our continent. And as such, in the mining, we are since the 1950s, starting out with the first copper projects in Chile, and still South America is one of our perceived home markets, but also Africa. We are active for decades, maybe not as much in terms of volume in other continents, but it's clearly also a continent which is in our focus. And yeah, great to be here. Thank you.
Thanks, Stefan, and great to have you. Who do we say next? Michael.
Yes, hello everyone. Thank you very much for the invitation. My name is Mike Seeger. I'm a mining engineer. My company is called IPEX Mining Capital Advisors GmbH, a company based in Germany, but also South African arm to it, IPEX Mining Capital Projects in Johannesburg. I've been involved in mining since the early 90s, and the business has been more and more going from mine development into financing of mining projects, very much with the technical angle and looking at always the scarcity of junior miners, junior and mid-tier miners. And the business has evolved into finding financing solutions for mining projects in diverse commodities: gold, metals, coal, battery minerals, an array of projects. The ticket size of these projects is typically anything between $5 and $30 million, sometimes reaching up to 50, and not higher than that. And that is a very big sweet spot for African mining projects. So clients come to us with financing requirements. They have either taken their project to a point or are operational and in need of capital. The task then is to look at the business case from resources and reserves right through to market, looking at a solid business case and then matching the different type of mining finance suitable for the project. Thank you. I look forward to this discussion.
Yeah, very, very appropriate for today. Thank you. And finally, Remy, last but not least.
Thanks, Fiona. My name is Remy Wilshinger. I'm the finance director of ARC Minerals. ARC is an exploration player in Zambia, reported in London on the London Stock Exchange. And we hold one of the largest tenements prospective for copper in the African copper belt. We have probably one of the most exciting exploration grounds in the African copper belt, and we are in the middle of our third season of drilling as we speak. And we have entered exclusive talks as well with Anglo American over the last few weeks to come to a partnership towards the end of the year.
Great, thank you indeed. We noticed that. So we'll come around to asking you about that. Thank you very much.
I'm Boris Kamstra. I'm a director of Pangea, which is Denham Capital's chosen team to look for investments in the mining sector within Africa. We recently made an investment in a company called Alphamin, which developed a tin mine in North Kivu, DRC. During the period of its development, I was the CEO for that company, and having delivered an operating mine, they allowed me to step aside and continue looking for other opportunities within the space.
Thank you, Boris. Yes, so you definitely successfully developed a tin mine in the DRC, a country viewed by even some of the most tough miners as very challenging. Can you outline the funding process you went through and whether being a listed junior on an international exchange in the form of Alphamin is all it's cracked up to be, or have you found that a disappointing process?
I don't think there's a definitive answer. Certainly being a listed junior, particularly in the area we operate in, has had its challenges. You often have to announce and disclose things that aren't necessarily in shareholders' benefit and aren't necessarily a risk in terms of the management team, but due process says you have to announce them. I think we've had an issue in that we are probably a private company that is listed, and we have the worst of both worlds. And so it would not be fair to cast judgment on the listing or the exchanges due to our, I suppose, rather strange shareholding with a very large shareholder and then a couple of other shareholders who are stalwart followers, which leaves us with very little market liquidity. But you do have the market who still set the price and the value of the company. So yeah, most of our capital raises went to Tremont Master Holdings, which is Denham's African mining investment arm. And many of our stalwart shareholders would pick up the balance, which would leave very little for the market in general. And I think that was tricky for us. But you know, if you have a solid shareholder who can foot the bill, you are able to do incredible things.
Yeah. So going back to your, is it Pangea or Pangea? How do you pronounce it?
Pangea.
Pangea, yes. Your experience with Pangea, a very interesting partnership with Western capital, but who supply risk capital, but African-based operators who understand the local mining landscape. Do you think that is the future in terms of a lot of Western funders now being wary of, perhaps excessively wary post-lockdown, of the political risks associated with a place like Africa? Do you think that is a successful formula that should be taken forward?
I think it certainly has, I think it certainly worked for us so far. We were able to identify an asset such as Alphamin in a very early stage, and it took us a while to get our head around all the risks and the mitigating factors for it. But at the end of the day, we were able to make a case that it wasn't as risky as the heuristics would let you believe it was, which meant that we were able to attract the capital and develop the mine. Going forward, what I am seeing is that really the only, predominantly in our space, so I don't talk for West Africa, but in the DRC and surrounding areas, one is seeing a dearth of Western capital. They seem to have retracted. Africa is currently, I suppose, in a risk-off kind of scenario with regards to Western investors. And we're seeing a lot of Chinese interest coming in and securing strategic supply of various of the minerals that they need to keep their industrial machine running.
Now let's get into the meat of the discussion. As we all know, life is anything but normal at the moment as the ripples from the pandemic spread far and wide with both radical economic and social impact. Two overwhelming themes are emerging which could potentially affect mining projects in Africa. The first is the potential for a widespread recession, of course, unlike any other we've seen, that is encompassing a reversal of globalization, where countries focus inwardly in their own particular funding needs, almost like medieval plague times when they built a wall around them, and potentially exclude others, not only literally in terms of closed borders, but financially in competition and pricing for capital. So that is potentially a challenge. But let's also be positive. The second theme is a dispersion of views on the elements of ESG, environment, social, and governance, where the Western equity markets would like to see a green recovery post-COVID, potentially benefiting investment in metals like cobalt, copper, nickel, and PGMs, to name a few. And many African governments could be looking to boost revenue and employment via new projects. So that's the positive opportunity. So my first question is to Stefan. Your bank is responsible, as you said, for export and project finance, but reading the underlying text, it's very strong in driving the transition to sustainable economic and ecological development in your lending and advice. How are you addressing the growing requirement for transparency in supply chains that are being demanded by Western off-takers of raw materials and the lenders to the miners? And potentially, what could that mean for project development in Africa?
Yeah, thanks, Fiona. That's indeed a very relevant and an actual issue. And it's not related at all to the pandemic. That's something which evolved before already and will increase even more. As I said, as we are acting in the interest of European parties, so we are also acting in the interest of European off-takers. And what we see in Germany and across Europe, that there is an increased focus of the off-takers in terms of transparency of the supply chain, and also recently including human rights, labor conditions, and things like that. All these corporates are under increasing pressure from capital markets, from shareholders, stockholders, whatever holders. It's not the banking industry who has to push them in the right direction. It's coming from other sources. And when we talk with them on specific offtakes and projects, that's increasingly one of the first issues. I mean, they have to deal with it. We can't do a lot with them. I mean, they have to create the value chain. We as the bank, we look at the project, and of course, as always, specifically when it comes to niche commodities, from a financing perspective, you do need to have offtakes. And in the past, you may have said, okay, there's an offtake agreement, there's a reputable offtaker, and that's it. And from the bank's perspective, that may be even it. But from the offtaker side, it's not it. They need to dig very deep into how that value chain is created. It's maybe not that complicated, or not complicated at all, if you talk about whatever, copper. If there is a mine in Africa, selling copper concentrate, it's very clear. It's going to a port facility, it's going on a ship, and it's going to Europe, and that's it. And then the offtaker takes the concentrate, and that's it. But if you look, for example, at rare earths, no offtaker needs the rare earth concentrate. They need the permanent magnets. And there are whatever 10 to 20 steps in the value chain in between there. And they have to create that value chain. That's not within the scope of the project itself. The project ends at the gate with the concentrate, and then in the case of rare earths and other minerals as well, there needs to be a supply chain, a value chain, which is transparent and ideally China-free, and this free and that free, and CO2-free. That's also a recent trend. They also need to have its CO2 at least minimal, not free, but minimal. There's a lot of requirements on the off-taker side to create the supply chain before they are able to sign an off-take agreement.
So if Western funding, which I think it is increasingly conditional on ESG issues, and you've just quoted a very strongly developing one, and on the other side, a perception of rising political risk and security of tenure in a few African countries, quite high profile in the news at the moment. Do you see China increasingly stepping into the gap of funding? For instance, Tesla and Glencore on cobalt, you know, that direct line. How do you view such a development? I've seen a description of Chinese funding of resources recently called debt trap diplomacy. So your view on, is China going to just take the whole space in Africa where they have much lower ESG hurdles? And what's the danger there?
I mean, the Chinese, they entered Africa quite early, many years ago already, with their first steps into the African mining sphere. And they, how can I say diplomatically, they left a mixed reputation on some names, on some countries. And they also made their experience and learned their lessons. I mean, in my view today, they are still there, but I don't see not necessarily more than before. Of course, Africa has a strategic relevance for China, but that's not new. So honestly, these days I don't see them neither less nor more active in the market. Of course, they're still there, but and maybe they give some. I don't have detailed insights, because once a project goes Chinese, it goes Chinese. There is no room for any Western financing party. We have in our whole portfolio not a single co-financing with any Chinese financing partner. I mean, my reading is they have a somewhat increased focus on ESG as well. Maybe also from their as lessons learned from their reputation from the past. but of course, nothing compared to today's and then future Western standards.
Yeah, thank you. Michael, could I ask you, in your role at MX Mining, could you comment on the key ingredients that you see as enabling African mining projects to raise capital for development, even in the face of the pandemic, scarcity of capital, etc.? And perhaps you could give us an example of a recent success?
Okay. Yes, so I mentioned the sort of mining value chain of resources, reserves, mining, processing, logistics, and market. And let's start with the market. So being a customer for the commodity, and if you go into that, gold will always sell. That's an easy deal to finance if the business value chain is there. Base metals, not that easy if the logistics path is not properly defined and doable. And then you have got coal, which is a whole different game again. So key ingredients are, you have to have a license, a tenure that enables you to prospect and mine. You need to have the resources and reserves that are economic there. You need to have a mining method that's economic, either open cast or underground. You must be able to process the ore to produce the product. And then when we go into, let's look at a base metal mine, it's no good having good mining and good processing or cost effective if you cannot transport the product to market. So the logistics is a huge component, and sometimes it's up to 50 or 2/3 of the price of the whole value chain. So the logistics has to work. As I mentioned, going back to the market needs to also be positive, have a good outlook. And then supporting this is a team. And not everyone in Africa has a team available to them or has a good team around them. So you need to partner. You need to find the right mining partners to execute your project. Experience is vital in this team. That makes the project fundable. And so these are key ingredients for success. And examples that I can share with you, for example, a metals project, a iron, titanium, vanadium project that was funded. We've been part of the financing in a very unconventional way. So the developers have spent money on exploration and technical work, but finance has been hard to come by. So the off-taker enters into an agreement for a defined period, for a defined amount of ore, and the off-taker finances the mineral processing plant and takes responsibility of mineral processing, logistics, and market. The size of that transaction is about $10 million, with a view to expand this project to much larger numbers, a factor of 5 to 10, should this first phase be successful. So that is a successful transaction. The second transaction is one where we found immediate traction, which was obviously a gold project, mid-sized gold project producing. Feasibility work has also been done. There's a competent person, a feasibility report. It's located, logistics doesn't matter for a gold project. It's easily flown out. And there we have equity funders queuing up for this project. So the ticket size here, again, it's below 20, between 15 and 20, not a problem at all. An example of difficulty, but and also slightly controversial, but it plays a role in Africa, and that is coal, it's energy. So you have at the one hand, you've got the environmental dynamic completely against coal. At the other hand, you've got social criteria, developmental agendas in Africa. And this mine struggled to find the total amount of financing, and who has stepped in. the Chinese equipment manufacturers on a lease basis. So these are transactions that are happening now in Africa, and they all are bespoke to the current situation and the current project developers' needs. Amongst many projects that do not make it, majority of projects, there are critical components missing, such as, for example, remoteness. So no use having a huge base metal project in the middle of nowhere in the logistics path is, it's not possible to transport the mineral to market. So many dynamics to take, to look at in order to make the business case fundable.
Yeah, very interesting. And interestingly, actually, we've seen different aspects to the remote site during the pandemic crisis. In one sense, absolutely, the logistics have been disrupted, flying stuff out. But in another sense, quite a lot of the very remote mines, both in Africa and in Russia, have actually been able to cope better with isolating staff and things. So yes, very interesting comments on the remoteness. Could I just ask you one other thing? Royalty streams. So we've seen an explosion in streaming as a source of finance for smaller juniors, particularly for those who are cash strapped. And royalty companies themselves have traditionally been very highly rated for a perception that they aren't exactly exposed to the operational issues that the underlying companies are. Just to Stefan's point, do you think in the future that a royalty company may also be answerable to the stream that it has taken on in an ESG and a transparency sense, and therefore maybe that source of financing is not as great as it was?
Yes, I think so, but this will be a function of where the royalty company is located. So in Western environments, in Western Europe and in America, absolutely, they will be answerable to ESG criteria. In Asia, I think it will be slightly different. They should be answerable to it, but it would, royalty companies also have it's money for a stream of metal. And should the stream of metal not transpire, it's step-in rights. So de facto quasi-ownership of the asset. And immediately we become answerable, maybe not now, but there's a prospect of being locked into a project where the royalty company is a stakeholder, although that is not what it's intended to be. But absolutely, I concur with you.
Yeah, great, thank you. So Remy, moving on to a slightly different topic, political risk. And I include in that security of tenure, safety issues that we've seen arising around West Africa, physical assaults, etc., cash flow remittance, regulatory stability, and a wider reach on corruption prosecution from the West, and how that all affects funding. So just taking that as a basket, you at ARC Minerals have recently signed an exclusivity agreement with Anglo American, and you're operating in Zambia, which is, for years seen as a really, really good jurisdiction to operate in, but recently has plummeted in the risk surveys like the Fraser Institute survey. Can you comment on how you finance exploration projects to get to the point where a major has enough resource data to get interested, and what sort of deposits and projects are likely to attract majors to farm-ins despite a deterioration in the political risk environment?
Thanks, Fiona. No, it's a very good question, and actually it's very interesting because we've had a few other projects in other parts of the world, especially a gold deposit in DRC, and actually the difference between Zambia and DRC is quite staggering. So, I mean, you probably have more experience than I have in this part of the world, but Zambia has a very strong rule of law, and at the end of the day, that's really what matters. You might hear and you might see a lot of headlines, negative headlines about taxation and royalties. You see a few of the big majors having their own issue with the Zambian government. But at the end of the day, the rule of law is really what matters, and more so for the exploration companies like we are than for the developers or the production company. Because I find that if you're a producer or you're in development stage, especially in early production, you have a lot of debt on your balance sheet as you're about to enter production. If the government were to mess with you, you're in a very tricky situation because you don't have a lot of room for maneuver. You have a schedule of payments which you need to meet very shortly in the next 24 months or 36 months. So any delay or disruption with your plan can be detrimental to your company, really. So exploration is different in that sense because, if you sit on really good grounds like we do, both actually in Zambia and we used to in DRC, what matters is the ownership of the title of the tenure, like you were saying. And that is really down to the rule of law. As long as you tick the box and you do whatever is asked of you by the government or by the minister, which is not, as drastic as it is for a mining company in production, you should not have any issues in countries like Zambia. And so that's what really we've experienced over the years is, and people who've worked in the country, and that includes Anglo, obviously, they do appreciate that what really matters at the end of the day when you own the title to the land is the rule of law. If there were to be any issues, either with local business people or with members of the government, you would just bring it to the court. And actually, if you've done everything by the book, you should not have to worry about it. And that's been the case for us, touch wood. That's been the case for most of the companies in that country. And that's pretty good to operate like this. When it comes to the investors and raising money, it's a good point because we've had issues in the past in raising money from bigger investors because of our DRC assets. Even though we've had no issues with the country and the deposit is outstanding in DRC, a lot of investors who were supporting us for the copper project in Zambia had an issue with us having exposure to DRC. So you do have to be careful where you are, not only because of the rule of law, but also because of the exposure that some investors you try to attract are not willing to take, which is quite important in that part of the world.
Yes, absolutely. So I have a few questions stemming from that. How do you cope with due diligence in the current environment of closed borders? So exploration, development projects, people really want to kick the tires. Has that been an issue, or was there enough work done ahead of time?
Well, we've been lucky. We had a lot of work done before. So, when we announced those deals, or not a deal, an agreement, but we've had other deals on the table as well at the time. And, the truth is those discussion takes, well over 6 months, sometimes a year to come to fruition, if they come to fruition at all. And so all the majors we've been talking to and some of the Chinese group have all been to sites at least once, some of them 3 times before the COVID situation. So when we came close to signing other deals, those people have had access to the data room for a year. They've had come to sites. Some of them operate very close to where we are. So it's very easy for them, within a few hours to come to site and spend time in the core shed or look at some of the data. And so this has not impacted us. Interestingly, we're doing some more work now in our discussions with Anglo American that requires access to site, and that has worked seamlessly for now. All those groups have a local presence already, and so for example, we've been sharing some soil samples with Anglo over the last few weeks, and they've sent some of their guys to pick up the samples, send them to the lab in Angola, which has then been sent to Johannesburg. So far, we've been lucky. We have not been impacted at all, and it's been the same with the drilling company. We're using a drilling company that has all the manpower and the equipment in country, and so we're not being affected by any border limitations.
Yes, you chose a very good partner there. I think it's the Australians that are struggling to get out to do due diligence. Yeah, absolutely. Yeah. And finally, do you think that, it's a favorite topic of mine, do you think investors on stock exchanges have different understandings of Africa? I've been associated with investors ever since I was a sell-side analyst, and people say to me, what does the market think of you? And I say, there is no one market. It could be Toronto's different, London's different, Australia's different, etc. I think you brought that up a little bit. Do you see certain stock exchanges more positive or more understanding of Africa than others?
Well, it feels, to some extent, and I think a lot of people have mentioned that in the past, it feels there is a bit of a time zone bias for most people, right? And it feels like Africa, more European-based investors understand and appreciate the upside and all the opportunities that Africa presents in all industries, by the way, but including in mining. And so there is probably a more positive lens in the eyes of the European investors than maybe in Australia or in Canada or in the US. And that's been quite good for us because we're listed in London. And I think you have a lot of companies with projects in Africa that have done extremely well over the last decades or 2 decades, which has given a lot of confidence for investors in Europe to support new projects in Africa. So I would say that there's a time zone bias. I don't have that much experience with the TSX or the ASX, but it feels like European investors are the ones that are a better fit for African projects.
Do you think that Africa needs more M&A now at the next level down to bulk up and therefore provide bigger investment vehicles for investors?
I think everything is cyclical and one kind of meanders around the moving average going forward. And I think at the moment we're in a period where the sort of junior mining space is an interesting one, in that in the past, the majors would really rely on junior developers funded by stock markets to go out and find new assets and then acquire them. And for a major, that is a very efficient use of capital, because the junior explorers who don't find anything fall by the wayside, and one can identify those that do and agglomerate them into something that is significant. And Mark Bristow has a perfect case in point with the Kibali mine. Was a junior explorer. He saw opportunity, saw potential, and did an extraordinarily good job in developing an operation there, and a world-class operation by every standard. We've seen a fall away in the funding of those junior explorers. So the pipeline, if you could consider mining like an inventory of various assets, there's normally a host of junior explorers in the mix, and they're either progressing or trying to keep their projects alive, and the good ones are tearing forward. And from that, there's a smaller component of people who are actually starting to develop, and then you have the guys who've actually got into production. And what we're seeing is that raft of explorers doesn't seem to be there anymore. Those that are there are being funded sufficiently to stay alive. I think shareholders believe that as long as there's a ticker on the board, there's hope, and they keep funding sufficiently just to keep the ticker on the board, but it's not really moving the project forward. So when we come along looking to invest in post-resource definition projects, there are very few of them out there coming through the ranks. Those that are there have been there for a while. And the reason they've been there for a while is that by our kind of metrics, they don't really make the grade for what we would deem investable. And then there's nothing else. So I think it's quite difficult to go into an M&A scenario in that I don't think there are that number of players in. I think in the gold space, there still are quite a number of smaller juniors. There's some great projects coming up out of Namibia and then further up the West African coast. Copper, I think, has become a Chinese play largely. They've snapped up most of the smaller copper operating mines. And for the rest, there are a lot of lithium plays coming into the market. I think they're going to find it hard work doing hard rock lithium mining in Africa and to make it viable. But certainly Mark has a point. If you are not in the catch net of the index trackers, you are excluded from a very, very big pool of capital. Mm. And I think what's exasperated things even further are the exchange traded funds in various metals. Because historically, if investors wanted exposure to, let's say, gold, they would go out and buy gold companies. And the same for many of the other metals. Nowadays, you can actually get exposure to the commodity itself. And that has induced, in my opinion, a fairly big degree of volatility in the markets, in that when the price is running, you have investors bailing into the ETFs, which pushes the price even further, drives the supply even tighter, pushes the price up further. And then as soon as it turns, they all bail and the market is flooded with physical commodity. So I think we're in an interesting space at the moment. I don't think there's nearly enough work being done on the ground to develop the next generation of top tier assets.
Yeah, I think Remy would agree with you. There's huge frustration on getting funding for explorations. Yes. So the concluding question comes really directly on from that, which is, do you see Africa having the potential to develop the institutions? So I know the banks are there, the South African banks are there, but the institutions such as the World Bank, the IMF, those kind of things, the African Development Bank really getting large, the pension funds from the new middle class. Do you see Africa being able to fund its own mining development? And particularly, we brought up the example of coal, which Western investors will no longer fund.
Yeah, I think the coal space, if you're in thermal coal, is going to be a very difficult space to be in going forward. Africa as a whole, I think the lack of functioning stock markets does make it problematic, and the lack of investor awareness of being able to invest in internationally listed companies by way of an international stock market. You don't necessarily have to have the stock market, the exchange in the same country as where the operation is. I don't think there is that level of sophistication yet in the general investor in Africa. The pension funds, I can't really speak for outside of South Africa. But I do think that there is a lot of capital that is available that is not finding its way into potentially good investments in the mining space. But having said that, one does need a well-diversified portfolio in the mining sector in order to get you a reasonable risk return. And I don't believe there are those kind of investors in Africa. I think once the people get that level of intelligence and not intelligence, expertise, they will generally relocate to where the bigger markets are. South Africa, UK, and Canada, Australia are the primary destinations.
Stefan, back to you, in case you're dozing off there. Africa's a continent massively rich and in parts relatively unexploited. Do you think that projected demand profiles for certain strategic commodities are so attractive that they offset perceptions of political risk? And I'm thinking of battery metals, copper, nickel. Nickel's not huge, but platinum group metals. So that's the question. We can be fearful of political risk, but are the commodities that Africa has so good that in the end it won't matter?
I mean, clearly in Europe, and in particular in Germany, there is a political focus on securing raw materials for the actual and proposed and new battery manufacturing sites in Europe. And of course, there is also in Germany, we have a government-supported scheme specifically for securing offtakes, which is very helpful in our finances, because we can use these government-guaranteed funds to support projects where they, for the project, the money is kind of free to use for whatever it takes, as long as they deal with a German offtaker. But of course, rather sooner than later, we talk about political risk wherever in the world. I would think that in case there is a German offtaker with the ability to secure a very important piece of offtake for his kind of battery manufacturing process, but it's going to happen in a quite unstable jurisdiction, and I would guess in this case that the government would be prepared to accept additional political risks compared to just a standard copper project from elsewhere, or standard iron ore project. So there is a clear political commitment, not only in Germany, but I can speak primarily for Germany, but I think that holds true for all Europe, to support these kind of transactions, and then be willing to accept political and maybe also technical and other risks they would otherwise not be prepared to take.
Yeah. And so the other risk is the particular commodities. I'd like Michael to propose to you, Stefan, his argument that coal is a base supplier of reliable energy in Africa. It's a job creator. It's an empowerment in South Africa, undoubtedly management empowerment creator. Michael, you argue to Stefan that actually in the ESG equation, S is also quite important, and therefore they should be backing coal projects. Over to you.
Yeah, so I must state that I'm a big fan of renewable energy, but at the same time, the S is a very important component in Africa. I'm going to give you an example of Botswana. Botswana is facing the diamond cliff. Diamond prices have dropped considerably, and it has got an abundance of coal. It is a natural coal supplier to South Africa, to the energy market, and even if once the logistics chain is built to the export markets. So Botswana has to play in the coal game. It has to embrace coal. It has to embrace clean coal technologies, but there's no ways that it will not look at coal. Let's look at go further up, landlocked countries that are a country like Malawi, for example, where there's no electricity from midway north to the country. So in an ideal world, they'd all be stacked with solar panels. But this is, I mean, it's proving a hard task. And so it's all about connectivity, cell phone towers, access to technologies. And Africa is saying, this is our chance as well. We need energy, we need electricity, and let's get as much as we can from renewables, but we still have to look at base load power. So Africans are embracing coal, whether we like it or not. Ideally, we'd say everything goes solar, everything is biomass, but it all comes at a challenge, and I'm going to give you the example of, again, Malawi. At the moment, if you look at the northern Malawi, around about Mzuzu area, you see the beautiful jungles being chopped off. No trees are left. It's barren land. People need energy, and what do they get? They they burn wood. So this is where the clean coal sector can play a significant role, and African countries are looking at that. So there's a social component, and then there's an environmental component, and a difficult balancing act. The Chinese are more tolerant to that. Western companies, if it's coal, it's a clear no-go, apart from a few companies, but let's say it's a no-go. So Africa is talking about social upliftment, and have, you know, in the E being now, if we give credence to that, it has to be as best as possible, but it's the social upliftment that will also contribute to a clean environment. Take Malawi, the Malawian example that I mentioned to you. So
yeah,
balancing.
Mike, I'm sorry.
Yeah.
Please, Stefan.
Yeah, no, I'm buying all these arguments. It's very clear that there is a lot more on coal than just dirty energy. It clearly has a strong social and labor perspective in Africa and also in parts of Southeast Asia. But really, the coal issue in Germany and Europe has become so much political, and once the debate gets political, nobody wants to hear arguments. These all are very good arguments, and I buy them all, but nobody wants to hear that. It's even, if I see it at KfW, at our kind of sister company, who do the development aid on behalf of our government. Development aid should, in a way, support coal because it's development for the host countries. But also there is no discussion anymore. It's just any kind of discussion is forbidden. It's political, and once you start this discussion, don't come with arguments. I don't want to hear it.
Yeah,
no, we decided to exit coal, and that's it. And just stop arguing.
Yes.
That's unfortunate, but in a nutshell, that's what it is.
It is what it is, and I'm going to give you the counter reality is rolling blackouts, no electricity, and when you're in that situation, you know, the argument doesn't count anymore about coal or no coal. It's all about we need electricity. But absolutely, so in an ideal world, we'll have everything with renewables and as quickly as possible, and I'm in full support of it, but it's a balancing act. So it's ESG. We need to balance them all. But Stefan, fully concur with you. You won't win this argument.
Yeah. Yes.
Yeah. On this specifically, on this, the S is just cancelled. The S doesn't exist in that discussion.
Yeah. Well, so
in Europe, yes, of course.
Yeah. So I'm going to be a bit flippant about the G as we start to circle towards two kind of closing topics. I'm going to be flippant and suggest that G is gold because everybody loves gold at the moment. So, and it's sort of greed neutral really, but less capital intensive and relatively shorter time to start up, therefore good for host country jobs and revenue. So let's all go for gold. On the Mark Bristow of Barrick justified the start of the recent M&A surge in gold majors as a necessity in order to achieve the scale needed to be included in the various indices that passive funds invest in. And I'm sure you're all aware of the growth in passive funds in the fund management industry, enormous. Is there an argument that mining in Africa needs scale to be able to attract significant funds flows? And why isn't M&A in the gold space happening in order to attract those funds? And I'd like actually everyone on the panel just to have a go. So starting with Remy, any views?
I mean, I think it's happened to some extent, right? When you see that Rheingold, who was a much smaller player than Barrick, basically took over Barrick, it looks pretty positive on Africa and Mark specifically.
Good point.
You know, you look at Rheingold, it's a Southern African player with a big focus on the DRC, taking over the #1 or the #2 at the time. Actually, you know, gold producer in the world with an America focus. I mean, it's probably the best praise for Africa that you can ever see in gold M&A, to be honest. So I think we have seen it to that extent. You know, the whole Birimian triangle in West Africa is extremely prospective, and you know, companies are extremely successful there, which I think, again, coming back to your earlier questions about the type of investors that would appreciate African projects, in a way, the rise in gold is helping countries like Senegal. Mali is going through a rough time, but you look at the share price of the companies playing in Mali, they've all recovered already as we speak now. So it's actually as well, people are showing confidence in Africa, even when there is a coup, because it turns out to actually be a positive for the country. So actually, you know, we were talking about the investor base and the time zone bias, but when you look at the success stories out of West Africa that are quoted on the TSX, again, it's amazing for praising the continent as a success story for a lot of mining companies. But I would go back to the point that, you know, the merger of Randgold and Barrick and the way it happened and who's leading Barrick today, I think it's the biggest praise for Africa.
That is a very good point. I was thinking of the next level down, but you've made an extremely good point. Yeah. Michael?
Yeah, so what a success story, Mark Brister and his team. And I salute them. So, however, you mentioned the below 1 million ounce, call it the 200,000 ounce to a million ounce deposit projects, and a large Barrick will, with big overheads, will not be their prime focus. And I believe there's a big gap in that sort of 200,000 to a million ounce project bracket size. And that's where private equity funds, that's where mid-tier streamers, that's where equipment financiers can play a role. And in my perspective is that, in actual fact, African projects need to be often downsized to prove that they can operate to be scaled at a later stage to large projects. So there's merit in actually starting smaller with a view of growing this in subsequent phases later to a much bigger project. That's my opinion.
Great. In fact, I'm going to ask Stefan a different question, the last question, and after that I'm going to ask each of the panelists to think of the one key point that they'd like to leave with the audience in terms of the discussion today. Stefan, my other big question was, will Africa have the ability to increasingly draw on its own funding sources and institutions, especially, as we've said, where there's an issue around coal projects that's become untouchable? So if the IMF is, which it said has funded 50 countries during COVID, World Bank under pressure, all of those things, will Africa and its growing middle class and the African Development Bank and the IDC, will they suddenly take control and develop funding ability for African projects?
Well, I think yes. I mean, still today we see in terms of the banking market, we see a strong, in terms of mining, a strong banking market in South Africa with a number of strong mining banks for decades, and they're rather growing than shrinking their business in my view. But banking is today just one part of the funding puzzle. When we briefly discussed before the non-banks, the neobanks, all these funds, and they're all also increasingly getting involved in Africa, as in other continents. They have, in my view, they have a somewhat different perception of political risks than banks have. They're more open, they're more flexible. They have a different view on political and jurisdictional risks, and they're primarily looking at the asset, at the deposits, and there is undoubtedly a huge potential in Africa. So I don't see any at least on the debt side or debt similar instruments. Don't see any scarcity or any bottleneck in funding projects in Africa. The bottleneck is rather, as well as in other parts of the world, is the equity.
Yeah, Yeah. Well, thank you. Can we draw to a close with each of yours comments on really financing a project in Africa? What do you think is key issue around it, and what your conclusion is, A, in the current environment, but B, in the longer term? A slightly wide remit, but all of you three have such incredible experience in this space that I'm sure the audience would like just a nugget to take away. So let's start with Michael.
Okay, I would, as a developer, focus on, I would work backwards and where the sources of monies that are available, and obviously they're there for gold, they're there for battery minerals, and they're also there for the energy, in the energy space. And I would work backwards and tailor my business case such that I can meet the financier's requirements. So a business case that works from resources, reserves, mining, processing, logistics to market. If that works, your project can be funded. I would also not, we discussed earlier on scale. So often it's all about getting started and slice or establish the project in phases, get operational with a view then to grow this into a mid and maybe later into a large project. But funders like a small operation that can be scaled up. Funders sometimes battle with huge project plans that never materialize because the scale is just too big. And then I would look at another message that I would give is there are diverse types of finance available. It's not, tailor your project to the different types of financing that are available in the alternative space. So these would be from conventional equity to a reverse listing into an existing company that has got cash and is looking for a project in Africa, to equipment suppliers that are looking for places to deploy their equipment, to cash flush mining contractors, to off-takers and streamers that want the metal. So different type of financing scenarios, and it's not one for all, it's bespoke to the project, but there are diverse types of finance available. But, and then lastly, your team. A good team will make a difficult project work. Have a good team and invite people into your team that have got experience that will make a project work. This would be key pointers from my side.
Yeah, absolutely, thank you. And that team, you can sell it to even to frosty Western investors.
Yeah.
Thank you.
Well, I think as an investor, what you need to, there are really only two absolutes in mining. The one is the commodity that you are targeting, and then generally an ore body will be a commodity specific ore body. And the second is grade. And those two things cannot change. Everything else can change. So if you find an asset that is really standalone in the world of its specific commodity, then it is worth looking at very hard. And we, as humans, generally rely on heuristics to make decisions and to guide our thought processes. So for instance, when we looked at Alphaman initially, I mean, even when Antoine Estaisen used to sit in the office above me, and he phoned me one day, he said, Alphaman, we've got to go and look very closely at it. I knew nothing about it. And, you know, when you don't know anything about anything, you Google it. And what poured out on my screen had me against the back wall. I said, Antoine, are you insane? You've lost your mind. And that was a heuristic around that asset. But after looking at it carefully and understanding where the levers are that can mitigate the risk of your investment, then you can move it forward. And particularly if it is a standalone world-class ore body in a commodity that you've got some faith in. I think the other thing that people need to think about, particularly those who are receiving the investment, is the incredible power of mining as a pioneering industry. mines need good infrastructure, they need skilled labor, they need good governance, and a host of other things, supplies that are required into a mine. So if you get a mine in an economically undeveloped area, the economic development that can be achieved through that asset is extraordinary. A really small example at Alphaman, we set up and we used to have satellite phones to be able to communicate with the mine, which worked very well until you had a thunderstorm, and then they didn't work at all. So we went to Vodacom and said, you know, we're building a world-class mine. We're going to have a lot of expatriates, a lot of international calls. We think it would be good if you could give us signal. They were wildly enthusiastic until we pointed out where the mine was, and that tempered their enthusiasm somewhat. But they did give us a mast, and it worked absolutely superbly for 2 months. And then we couldn't get signal. It was a disaster. The reason being, they designed the mast for 100 people. There were over 1,000 connections on that mast. And in the villages around us, there were stores selling airtime, selling power recharge, because there obviously aren't wall sockets around our area, selling M-Pesa, which is a banking facility. And that has a knock-on effect all the way down. And it happened not only with, we now have a massive tower up there, and it is still overloaded, but we'll work on that. We also opened up all the roads from Walikali right through to Kisangani. And when you drive down those roads now, compared to what they were, the level of economic activity that is happening is just extraordinary. People bringing goods in, farmers eventually be able to take goods out. So for people who are able to host a mining investment, one has to nurture them, and one must not be blind to the ramification, the multiplying effects that does have on the economies around you.
Remy, may I ask your just concluding comments, please?
Thank you, Fiona. Well, I'm not going to actually give advice to the investor base. I think for the exploration sector, it's a complete nightmare, because if you think about it, the investor base you have for the exploration companies, which by definition, a lot of them are junior companies, is basically 99% non-geologist investor base. And so it's impossible for a public investor to be able to know whether your project, the ground you have with some geochemistry, geophysics, some drill intersection, it's very hard for a generalist investor, which is the bulk of the audience in the stock exchange, to understand why your project is so much more prospective than the guy next door in the same country, in the same belt, or in another country, or in another continent. And that is a big issue for the companies, because when you sit on amazing grounds like we do, to explain to the investor base, all of them, by the way, retail, family office, asset managers, private equity, that your ground is really special, unless you're talking to a geologist in front of you, they'll have no idea whether it is indeed special compared to the ground next door, or the guys in the DRC side, or in another country. And that's the big frustration here. And I think Canada, on that point, and Australia to some extent, is better educated on the geology side. And that's a shame, because the big money is made on the exploration side. You know, you look at projects in development and in production, you know, the quantum remains within 100% really. If you're in exploration, we're talking 1 to 10, 1 to 100. It's a bit like a tech startup. And so the problem you have now, and I find that we find the right balance at ARC, but is as a manager, you end up early on, you know, giving in to the majors for two reasons. One, because they are the only guys who appreciate the prospectivity of your ground. And second, you're in a rush to prove to the market that your ground is prospective. And the only way for you to do that to some extent is by, you know, throwing a big name out there and saying, look, we've just done a JV with XYZ. But the problem in doing this so early is that you're basically giving them the bulk of the asset on the very cheap. But that's because you can't find equally educated geologists on the buy side that are willing to support you by putting 5% or 10% into the company. And so the only people that actually can appreciate your ground are the industry players, which I think you don't want too early in the growth of your company, because they are supposed to be the exit strategy. It's a bit like if you let Google invest in your tech startup when you're worth $5 million, well, it defeats the purpose of the whole project. So That's the problem here. Apart from the PE fund that want control and the majors that want control, no one else has the capacity to appreciate how good your project is or how bad your project is. So I would really say, generally speaking, that for family offices and asset managers that have the capability to bring in geology expertise, they really should, because that's where the big money is, and they can really then differentiate between that $20 million or $50 million company that has a 10x potential and the other one actually that is completely overvalued. So that's my view and my frustration. Thank you.
A very good summing up. And I know of juniors who 20 years ago found Canada, as you said, a really supermarket to go to, because you had dentists, doctors, that kind of range of money that had made money in juniors before, and they were prepared to risk their money. And in recent years, I'm afraid to say, they've been investing. Gold was competing, but so was what do they call it there? It's dacha in South Africa, but it's cannabis companies. They were competing with cannabis and tech companies. So that range of retail money disappeared. So we can understand your frustration. On that note, Stefan, would you like to give your concluding comments, please?
I mean, first of all, I would underwrite anything Michael and Remy were saying. So instead of repeating that, I would like to conclude with, again, coming back to the environmental and social issue. This clearly in any type of bank-driven financing has become the most dominant piece of due diligence in any mining project. You would think you would discuss endlessly on markets, on technologies, on ore bodies, on logistics, and on all these obvious things. These are typical discussions. Once you did it before, you're quite quickly through. But specifically environmental and social is so specific to any project, and the regulation and requirements around it getting harder and harder. Now in the banking sphere with the so-called equator principles, which is the translation of the IFC performance standards for bank purposes. We are entering the EP4 phase now from October on, with again additional requirements, this time towards human rights and climate change. So it's getting more and more consultants have to be hired, and it has become an industry of its own. I mean, it's for good at the end of the day, but at some point you need to control that. Because at some point you need to come to a close. You need to come to a point. You can discuss that endlessly, and this is clearly the trend. Environmental and social. Again, it is important and it should be important, but you need to keep it under control. Otherwise, you never get a deal done.
Yeah. Thank you, Stefan. I heard somebody on a panel recently saying the companies need to take back the argument, and they need to be setting very clear guidelines so that the funders who are now dominating the conversation come back into balance. So the companies need to take control of the argument. Well, that's true.
That's true. And the sooner they deal with that issue, the sooner we get done. It's typically underestimated in terms of time and efforts.
Well, thank you so much, everybody, for your presence from a global spread. Really appreciate it, and thoroughly enjoyed it. Thank you.
Thank you.
Fiona. Thank you, everyone.
Thank you.